Welcome back to my channel, guys. Today we're going to review the MIR protocol. Okay, so this is a top-down view. The MIR protocol has some good governance, excellent team membership. It does have some negativity with like token movement and price inflation. But that being said, and maybe some uncertainties with the distributed developer teams. But besides that, it's a pretty solid project. And so I did make a investment into this. I put a small investment into this one. So what does this problem solve? It allows for you to trade securities or like Amazon, Microsoft, Tesla. You can trade these securities on the blockchain. It allows for the creation of fungible assets. Assets known as synthetics that track the price of real-world assets to the blockchain, and so it basically mirrors these real-world assets so that you can trade them on blockchains. These assets use oracles to connect the blockchain to real-world data points, right? So that's the service provided. So you can trade on any data feed. So an interesting thing to think about is yes, you could trade Amazon, but you could also trade the weather. You could trade unemployment rates. You could trade anything because all it is trading on data points. And as long as those data points are trusted and unbiased and reliable, you can trade anything. And so you can see that the liquidity for this is increasing. The volume is steadily going up. In fact, it's outperforming Synthetics, the similar competitor on Ethereum, as far as volume is concerned. One thing I will note is that the token itself, the main platform token, is the #1 trader. That means people are speculating about the future adoption of this platform more than the services provided is proving itself. But in my opinion, I think that this will change. I see something like this as negative, but I also see it as, people think that it has a future. So it can, like for instance, HoneySwap, for instance, that's an exchange on XDAI. The exchange didn't really get massive adoption yet, but the token was the #1 trader on HoneySwap, meaning people were speculating more about its future than its actual utility. Same thing here. When the platform's own token is the most traded thing, that means people are speculating more about its future than its actual use case. But these are very valuable. Like it is trading, and this is a service provided I could see myself using, and I probably will use in the future. All right, and so I'm going to go into how you can use this as part of your strategy. How you can see, this is one of the great things about this platform is it actually has a product that you can use, right? And I'm going to go into that, and then I'm going to go into that right now, and you can just watch the video and fast forward through it if you want to get back to the review. But this I actually think will help your trading strategy by using this. So basically, how does Synthetics works? To mint an asset, lock up 150% of current asset value in Terra stablecoins or M assets as collateral. If asset rises above collateral threshold, then collateral is liquidated, right? When price of M asset drifts from primary market incentive forms to purchase or sell the asset to mint or burn for collateral. So, you put up collateral, or I'll get deeper into this. I'm just going to do the explainer now. But basically, you're using collateral ratios and human incentives to get these instruments that trade based on Oracle data feeds. And so it's just trading on any data. You can trade on the weather. You can trade on anything. And all it is a data feed being provided by a trusted source, and you could trade on it. And it uses collateral and human incentives to establish this. Okay. When markets are closed, data feeds are interrupted, mint and burn is disabled, but trading is still allowed. So it'll probably have gap. Maybe it'll trade to what people think, and then it'll gap to wherever the new data feed opens when these capabilities are opened. All right, so collateral providing is a short position. If prices rise, then synthetic asset collateral provides they feel pressured to add more collateral or lose the 150% they put in. And we'll get into an explainer of the how this works. The human incentive, how they establish this. Margin call to liquidate collateral in order to reestablish accepted ratio. So basically, M asset minimum ratio. This is just some of the explainers. The total value of collateral divided by the total value of minted assets gives you your rate at any moment, like your rate. So this is the current value, and this is the collateral that you put in, right? Like whatever the market rate is, and this ratio at our current time in space, right? The current ratio as it currently stands based on how these things are trading. So this is what you mint, this is what you put up. It should be like acceptable thresholds. Effective C ratio at any moment in time. So yeah, it's the collateral ratio at any moment in time. Collateralized debt positions strive to meet a certain threshold, so the time has to be greater than the ratio at the minimum. So like if it's 150, that's pretty much equal to the ratio minimum, right? So you want something above this, 150%, which means for every dollar, I have to put up $1.50 in collateral, right? And this ensures the platform that it's safe, that things are safe. But at this point, when it gets to about 150, it'll start selling off your collateral at the market. And so like this R is the ratio that is chosen to launch, like whatever that ratio is what creates this quantity, that will be sold off. All right, so let's get into an example. All right. So a user start ratio is 200%, right? This user is someone coming to this platform and they want to use services like me or you. Like this is a very valuable service, right? So so this user deposits $200 and they receive $100 of tradable asset, right? Like Tesla shares, right? Shares, $100 worth, okay? Now the market causes it to move up 33%. We're going to go through the bear and the bull, right? So it could go down, it could go up. I'm going to go through the bullish scenario first. Okay. So if you just held, you'd still have, if you did nothing, right? You just held those shares. Well, now your shares are worth $133, right? The Tesla shares that you bought, they're worth $133. And that's what you owe, right? You owe the same shares back, right? So you just give them back and you get back your collateral. Right? So nothing happens if you just hold on to it. However, this isn't the reason people are holding these, right? They usually want to do something with those shares when they mint them. This is the creation of an asset. You are minting this asset into existence, this tradable asset, and this is how you mint them into existence. Okay, so let's say you sold that asset into the market, right? Well, now you have to buy it back in order to protect yourself from liquidation. So you turned it into $100 stable coin at the moment, right? Up here, it was worth $100. You sold it the moment you got it and got $100, right? But now you need it back because you owe the same amount of shares. So you got to put in that share amount is worth $133 because it moved up in price. So now you have to use $33 of your own money to buy back those same shares from the market. And then you close the position and you're down $33, which is 16%. So that you took a short position and you lost. A short position is betting against the market. And, because right here we're seeing that the market went up, right? And since it's double collateral, the amount we're talking about that you lost is how much you had to put up. So you put $200 in and you lost $33. That's 16%. So this is the amount that you put up. This is the amount of capital that you put into the system, and your yield was negative 33. So you had a negative 16%. That's what we're basing that percentage off of. Okay, so liquidation. Now we're going to explain liquidation. So liquidation price goes up, protocol will attempt, so it closes out pretty much right at the 150 mark or close to it. And so that's what we're going to use. The price goes, so let's say price goes up, protocol will attempt to close out the position. Users can buy collateral for a discount. So what happens is the smart contracts open up your collateral for sale, right, at a discount rate for other users. So they have an incentive to buy it and quickly close out this position for you. And they have an incentive to do it, and they're going to make a profit on it, right? So at the 150% mark, D is the auction discount rate, and this is controlled by that token. When this is controlled by the MIR token, it's one of those things that the token controls. And this is the incentive rate for getting the market to close this position so that this platform works. It's the and so people will behave in their own interest, and they'll do this. So basically, users, it opens up your collateral to be sold. The users provide that $133 worth of shares, right? And they receive back 16, so basically the shares to be burned, right, is $133. The discount rate that they're giving them a bonus. They're incentivizing the market to quickly close out this position. So they're giving them 16% more in collateral than the shares are worth, right? So they're paying them more through collateral, your collateral that they're selling off, they're giving it 16% bonus. So $154 worth of collateral is taken out of your collateral. And and whatever's left, you can still acquire, right? By just signing a contract and pulling it out. So if you just held in this scenario, you lose 11%. Like if you just opened up this position, you didn't, you weren't shorting or anything, you forgot to do anything with the shares that you got, you'd lose 11%. Now look at the comparison here, right? Versus zero. So this is why that liquidation's bad, right? It forces action from it creates an incentive for the market to close out your position. And if you sold it like you did this whole market spiel right here, in this case, you're much worse off. You're negative 27% versus 16. So you're incentivized to either provide liquidity or close the position, because you're going to lose worse if you don't close the position. So all of these incentives are how we establish this is how we establish having these synthetic assets. Is through these incentive models, okay? And then so let's say that in a case where it goes down, you won, you do nothing, you still don't get any money, right? Because you just held the shares. However, if you did sell, the maximum you'll ever get is 50% with shorting, but in this case you gain 16% because you sold it for the market for $100, and then you bought it back for $77 because you owe $77 back, and you get your $200 collateral back, so your profit is $33. So you made 16%. And but the max you'll ever get is $100. Like if it dropped to zero, right? Like if the stock went to zero, then you could it's like signing the contract. You get to keep your $100. $100 over 200 is 50%. So and so that's how it works. This is a very valuable product. And it allows for you, if you want to store your value, you can store your value in stocks. You can store your value in silver, in gold, in the weather, or whatever. You could find the most stable data points or data points that you want to store your wealth in or trade or whatever. Extremely valuable service. All right, so I'm going to get into this platform. Yes, I did buy this token. I do think it will go up in value. Future increase in demand for token, I do think that is the case. I see current awareness for this kind of project is low. The Terra team built this. I made a mistake of not investing enough in Terra. I'm sure many of you guys are aware of how that token is performed. The Terra token team is the ones who made this. Before marketing campaign, so basically the awareness of this is quite low compared to a project like this normally. 27,000 followers on the Twitter and team, on the project team. Telegram is low. So I actually do think that this is kind of early. The YouTube exposure is low. Social media awareness lower than it usually is. As far as whether, I'm going to have to go faster because this video is going to be super long, right? So major upcoming events, they're just expanding their services provided, providing more things like you could trade unemployment rates, you can trade macro tokens, macro data points. That's just more services provided. Expanding services is what we will see coming in the months. So they're just going to keep expanding their services. Market excitement for price momentum likely. I do think that could be the case. Money needed for price to move price up decreases. Exactly. Token on the sell side decreases. I expect that to be the case. Okay, so as far as inflation for this project goes, the inflation rate on the token holders control rate. So the inflation rate for this project is very massive. Okay, but there's more than just one element to this. You must use the platform not to feel this horrible inflation. And this is actually how they incentivize people to make this platform useful, right? So if you're a liquidity provider, like this is where the inflationary effects are coming from. Big source of MIR inflation. So in order to not feel this inflation, we're going to take a look right here. You could see right here, this is where all the inflation is coming from token issuance, is for MIR staking and M-asset liquidity provider staking. So in order to not feel this really bad inflation that they have, 233%, oh my goodness, insane inflation, you have to be a user. And so that kind of sucks as an investor because you're going to get hyperinflation against your tokens. However, if you're a liquidity provider, if you use this platform, that's when you don't feel as much inflationary effects. And so that's what they kind of need that in place because it brings liquidity to this platform and makes it usable and attracts users. So as an investor, if you're going to be a passive investor, you're going to feel the burn with that. But however, if you're involved with this ecosystem, you could benefit substantially. So if you're someone who wants to use these services, and I am, you could benefit from that. Token supply distribution. It's really bad token supply distribution, but one of the things that mitigates that is the dividend irrelevancy. You do get paid for closing out those collateralized debt positions. So when you close your debt position, when you close this position, when this happens, there's a fee that goes to the token holders, and that is a dividend. That is like a services provided fee. So that is actually a good thing for the token. Token is up 5x in 3 months. So that is a little bit of a scary thing for people that want to jump in on something. But like I said, its market cap is low for what they could be offering. So it's 400 million. Yes, that is a bigger market cap. But the value of the target market on which they are shooting for is trading and securities, stocks, derivatives, real world assets on the blockchain, which is $1 trillion market. And so, I see that as not being the biggest market cap. The token is used for collateral deposition fees to stakers. So that's that dividend. It's staked to create polls, and token is used for governance. So basically being in control of the metrics of this platform. So you get paid those dividends, and you also are being, using the token to farm for a liquidity provider. Token is not burned. There's no burn mechanism. Niche, it's live. It's serving this, as I said earlier, its services provided is up, and it's basically allowing you to trade anything, really. Like any number instrument, right? Like the weather, unemployment, etc. You could trade any of that stuff. All right. So as far as governance, you can spend the community pool. So for how spending goes in the future, you could choose which oracles are used. You'll be able to be in control of that with the token. Set minimum collateral ratios, set auction discount rates, decide what cannot be traded. So you're basically in control of the platform as a token holder. High value people prioritize upgrades. I do think that will be the case. Okay, so I made the mistake of not buying enough Terra, but I'm never going to make that again, and I'm going to make sure I always invest with Duqua because he's a founder. He's no longer in control, but he's contributing and guiding the ecosystem. But yes, this is a key player now in the cryptocurrency space, and he impressive achievements. Like he's made a $1 billion entity from the Terra, and even this will probably be $1 billion entity soon enough. Now this platform is decentralized, in decentralized control. The token holders control it. So we're really saying the leadership of this is a community and user run collaborative effort, but powerful initial team. So the leadership of this isn't really the CEO anymore. It's just a community kind of thing. And I put that as an 8. Because, like the people that are going to be controlling this will be the users, the developers. And so I think that will be, that'll allow for businesses to integrate into it. And I do think that will be a powerful form of control. So basically it's community run. It's a community. The community equals the team. So that's something that you have to think about in your head. Developer compensation. So let's take a look at that. So as far as, let me see. Okay, so developer, this right here is to fund the developers community pool, and that is voted on by the token holders, as well as the MIR. Developers can fork the MIR wallet and be rewarded MIR tokens by community for attracting users to MIR protocol. We want to attract users of all backgrounds, MIR particularly financially disenfranchised users. The goal is sharing MIR's long-term creation as a transformative power of decentralized synthetic asset realization. So basically compensating developers for on-chain MIR community fund, for bringing in users. In traditional systems, fair launches, as they quote, only reward traders and liquidity providers. Only developers that issue tokens make money, so those developers that issue tokens to make money, which has led to millions of crap coins and no users. The MIR protocol uses farming that allows marginal businesses to be built on the network. We expect developers in the world to add their on-ramps, localizations, curate assets in line with their drive user engagement with mirrored assets. So basically, if you have smart contracts that connect with this platform and bring users, they're going to reward you. The fund will reward you. So basically, the people that will own these tokens or get paid these tokens are developers, and they'll also be the ones in control of this platform. So I do think that is good. So as far as the long term for this project, I don't think that this project will have a forever market share, because the real world is coming to crypto. So, I do think that it'll always have something to mirror, like weather, unemployment, etc. But its biggest use case is going to be securities. And that's probably I'm putting here, this is completely speculative, but I'm putting that it's going to be 2 to 7 years that it'll have its max market value for trading securities, because the old world is going to move to crypto. Okay, and so it's mirroring the old world, but as the old world moves into the new, it'll have less and less to mirror, right? But it'll still be able to trade things like employment, weather, etc. It's an interim protocol, in my opinion. The current system will come on the blockchain, not be mirrored onto it. However, data feeds can be traded, such as weather, etc. So basically, it will, I could see that as being a factor. But, if it basically could trade on any data feed, so I could be wrong. There could be tons of things that it could trade on in the future, even if it's not trading on stocks. But stocks are going to come into blockchain. There won't be this separation in the future, right, between the old system and blockchain. In the future, the whole systems will be on blockchain. As far as clear mission statement, positive impact on the world, answer is why. Well, it's a distributed community, so there's no way they could coalesce around one vision, right? Because it is a distributed community, so that is something to consider. And as far as the team, the community is a distributed community. So at first it was a Terra team selected by token holders. However, the team rewarded mechanism so this project is run by a decentralized community now. So you have to take that in consideration if you think that's good or bad. High value upgrades. I do expect high value upgrades, high services provided to increase, and I do expect large businesses to demand the token in the future so that businesses that utilize this as a service will want a voice over the traded items in the metrics. So I do see businesses buying it because they will want a voice over the metrics of this platform. Strategic partnerships. They're working with the band protocol, but that's their provider. It's not really a partnership. But the partnerships aren't that relevant. It's just the services provided that's relevant for this. All right. So as far as the best of the competition, MIR is way easier to use than Synthetics. I have found that Synthetics exchange, but it was greeted with difficulty on how to acquire synthetic Ethereum so I can even trade. If it takes more than 10 minutes, people aren't going to use it. And I was looking around, and I was actively looking around for how to trade Synthetics. Here's an example. I went to the Synthetics website, and I couldn't even see where I could trade. And you have to go scroll down and look at their different things that utilize it. But it's made for nerds right now. And I could nerd out and check it out, but I'm someone who wanted to quickly see what services provider was, and it actually took me time. Now, the way I see Synthetics is it's a liquidity provider for different apps to use these synthetic assets. So it might have more customers, it might be a back end kind of thing. And whereas MIR is straight up a service provider, it's simpler to understand. And right here is their app. It took me just a few seconds to find it. And by the way, MIR is overtaking Synthetics in volume. So, it's probably because it's easier. And this one has 600% bigger market cap. So, you can see why I'm investing, right? So it's basically MIR. It has more transaction volume than Synthetics, okay? ChainX thinks that this is because of cross-chain. They're saying, because it's Terra and Ethereum, that's why it's doing it. But I think it's because it's easy, right? But I heard ChainX talking about it, and ChainX was thinking it was because it was cross-chain. And by the way, ChainX is going for some of this market as well. And I'm bullish on ChainX as well. And I do think that element of being cross-chain is going to be valuable because you're going to be able to feed these services into any blockchain. Current development team was the Terra team mostly, but now it's being overtaken by the community. So all of this, that team is able to deliver. External transfer catalyst might be an issue. This could become an issue if they establish enough liquidity. But if they establish enough liquidity, they're going to have market share. They are doing that, and they had a good incentive model to get people involved and to make their platform useful with that liquidity mining. And so basically, I think when people start using it and it has liquidity at their exchange, it'll keep that liquidity, it'll keep that usefulness in people that use it. Easier to use than its competition, so I think difficulty of internal transfer will not be an issue. So basically, they don't have competition. Because Synthetics is too difficult. If it takes more than 10 minutes to learn, it's useless. Okay, easy. It's super easy option. I think I even looked at Synthetics and I didn't find it within a reasonable time. So that's why I think this one has pretty much no competition. Future marketing plans. I don't think they even need marketing. It's irrelevant because their services provided will attract users like me. More people using it, absolutely. It will be used on DEXs, and so its liquidity will be provided in DEXs. It was easy to use, and so tokens per person to go down. I expect that to be the case. It's easy to acquire, and this is irrelevant because it's part of that. All right, I think I covered everything with this, guys. The pros, those that use the platform own the tokens, right? And those that use it must own these tokens. So keep that in mind. You're going to be feeling bad inflation. You got to be a user. That's the people who are going to benefit most from the price depreciation. Cons, it's based on, there is complicated smart contract risks with these things. So keep that in mind that, when you have several different processes that are interconnected, like oracles and such, there's a risk in every single connection. And so there is smart contract risk. And it's got a very high inflation for those who don't use the platform. All right, guys, that's in total the MIR protocol. I did buy a share of this, some shares. And if you want breaking news, check out my Patreon. I provide this information first to my Patreons. They get to see reviews like this first. And they get to see breaking news first from critical trades and critical data, and they get personalized interaction with me whenever they please. Okay, so if you guys like this, like and subscribe. I look forward to servicing you guys in the future and providing the best data that I can. All right, guys.